Thanks everybody for joining us. The topic of this discussion is what's next for gold and silver equities. I think just following on from maybe that presentation is a good place to start. You're looking at the miners and looking at them disappointing maybe in the past, and saying that now's the right time to consider them. But is there a sense that they've sort of learned the lessons of the last cycle, and some of the commitment to free cash flow is sort of sustainable going forward? I don't know if anybody has an opinion on that kind of topic.
Someone else has talked. We all hope so. I think that they've learned a lesson, but I'm a bit cautious that we really see in the next upcycle, which we all hope, of course, that it's coming, that we're really going to see a change in attitude. I think the same mistakes are getting repeated. Many companies have the same management teams on board that have made mistakes in the past. So I'm a bit cautious and concerned that we won't see lessons learned in the future. And I hope I'm wrong. It's my attitude. It's my hope.
I think one thing to point out, though, is that in the last cycle, a lot of management's decision-making around large, low-grade deposits was actually driven by investors requesting more ounces, more production. And so it's also important as investors, I think, this time to think about the last cycle and in so much as you're influencing the management teams of the large gold companies, to consider what it is you're actually asking of them, because a lot of what happened was ultimately at the request of shareholders, I think, and that's not to take away all the blame, because a lot of excess was clearly a result of management teams, but in fact, shareholders participated in that as well, based on their demands.
I think it will be easier for them than ever this time, because if you heard my speech this morning, I believe that gold and silver and the metals the physical metals will go up dramatically in the next few years, and whether it's $10,000 an ounce for gold, or which would be 300 at least for silver, or whether it's more with hyperinflation. When I say 10,000, I think that we will see in today's price level or today's cost. With inflation, it could be 50,000. I believe we will have hyperinflation. So I think that the mining companies will be saved by the market, and that will hide a lot of mistakes. So it will be quite easy for them. But I just wish that this time they're not going to spend the money that they make again, but that they actually will try to generate a positive cash flow.
So, but as you start to see production growth getting valued more, doesn't that sort of prompt those types of investment decisions that you were talking about in terms of the lower grade projects getting developed, and maybe they're not necessarily the wisest use of capital?
That's the risk. That's why I'm saying that, this time they bloody well try to get positive cash flow, because they never have in the past. But will they? Well, we will see.
So
also maybe I think if you compare it to our life, or let's say a lot of good companies have gone like in the fitness studio. They really lost the weight and arranged themselves with a lower environment. So hopefully they don't get fat again after they're making some good money right now. And then after that they start with the more uneconomic stuff again.
But I guess one of the concerns in the sector is we've started to see the equity markets open up again, and we've seen equity financings from a number of companies in the first 3 or 4 months of the year. And one of the concerns that we hear from investors is that there's a lot more out there if it were to become available. So when you're talking about investors demonstrating a little bit of restraint in terms of providing that capital to companies, do you think that's going to happen? Or do you think there's a wave of equity that's sort of going to come out, and how do investors sort of avoid participating in that?
Well, remember, I mean, in a way, mining has been an industry in transition in terms of investment from kind of blue chip funds and endowments. And if you think about the combined market cap of mining companies and you contrast that to most other sectors, it's tiny. And I think as the industry matures and you bring in funds beyond the specialist mining funds, the gold funds, hopefully that will bring discipline as well. Now it might not, but I think the hope is, and I've seen this actually with a lot of management teams from the large producers. I think there is a genuine effort being made to reduce costs, to instill a type of discipline that has really been pounded on by not only analysts but the buy side over the last few years. So I'm optimistic that at the larger end of the scale that we're going to see some of that discipline. I think, however, in the junior space, in the microcap space, it's likely to go back to where it was before, which is excess and waste.
I'd like to add a point. As I see the world, this will be virtually the only sector that does well in coming years. I see all the assets financed by the credit bubbles, which is general stocks, bonds, and property, go down substantially in real terms. That is, in real terms, that is against gold. With hyperinflation, they might go up, but in real terms, they will go down dramatically against gold. I mean, I see the Dow falling at least 90-95% against gold from here on, for example, and also other indices. So if that's the case, if I'm right in that forecast, and many of you might say that I'm totally wrong, but I believe firmly that the world is in a total mess, and therefore the world will suffer. And if that's the case, there will not be that much financing available because the general financial system is unhealthy, it won't do well. So there might not be as much financing available for the miners as in a normal boom era. You got one more guy there who's...
Yeah, I'll go with what Anthony was saying earlier, that the real issue starts with investors. And so we can, of course, managements have had problems and they continue to have problems. The big problem is that investors invest without actually evaluating these companies. A lot of money that has come into the sector in the last few months has gone into gold ETFs, GDX and GDXJ, which to me is a signal that a lot of money is coming into the sector because they want to match their fund with the index rather than to invest for value. And I think this is a recipe to repeat the same cycle that we had in the last 6-7 years. So I am actually skeptical about this huge boom in the share price in the recent past.
So, but given that dynamic, if a lot of the money coming into the sector is sort of passive into the ETF, shouldn't that provide opportunities for more rigorous sort of asset evaluation and stock selection?
Well, because I come across generalist funds who just want to invest. They don't really care about whether their fund, what they invest in, provides them a dividend and cash flow or profit. They just want to invest. So as long as people don't invest for value in the medium and long term, this will just be a destruction of value because they are providing wrong signals to the management of these companies. And you can see that with some of the financings that the junior mining companies are trying to do. They have not been able to do financings. I know companies that are trying to do financing at a significantly lower price than what their share price is, but still they can't raise money, which again tells me that these are speculative investors who want to just be in liquid stocks. They lack the courage to stay invested for 4 months, the lock-in period in Canada.
Yeah, I agree with that. I think that's one of the problems, that the investor focus is really on short-term profit making. So it's maybe 2 quarters, maybe maximum 1 year. The long-term sustainability of our industry is in nobody's concern. It's really, an investor does not look, do we produce gold still in 10 years, or what gold price do we need in order to produce gold still in 10 years. So it's our nature, the nature of investors, to be short-term focused. And I can't see this to change. If the gold price really moves to $6,000, $7,000, $8,000, now you're going to see investors going crazy. And they don't look, where's this world in 10 years' time? They're going to look, how much money do I make over the next 12 months? and that won't change.
That said, I think one of the changes that you've seen in the industry over the past 5 years is really the advent of private equity and also the massive inflow of funds to the royalty and stream companies. So I think while you're right, at the same time there is now a class of investors which has probably never been there in the level of import that it is today, making longer term investments. I mean, most of these funds have 7 to 10 year lives with 3-year disposition periods. Arguably a royalty company has an indefinite life. So I agree with what you're saying about fund flows, and that's a factor, but at the same time there is a new pool of capital building, which is probably $15 billion in private equity, and I'm not sure what it is in the royalty sector, but it's a significant pool of capital that's financing mines and has a longer term horizon.
So I find this fascinating because my expectation was that, the sort of thought would be, this is what companies need to be doing differently. And we have a panel of investors saying that, no, investors need to sort of take the lead and instill that discipline. So I find that surprising anyways. I was a little bit remiss in not introducing the panel at the start, but I think you've probably seen everybody over the past couple of days doing their own presentations, and their bios are at the back of the agenda if you want to read more about them. So we'll skip that part. I guess one of the things that we've seen over the last couple months is the return of M&A activity into the space in little sort of drips and drabs. Do you think that more consolidation is needed in the sector, or do you see more coming?
No, I would say so, yes. The first capital, or the big chunk of capital coming in, especially royalty companies looking for more ground to buy, more assets to buy. So the M&A activities also combining will happen through the first phase of capital infusion, in my opinion. And there might be some good projects among them. But then again, with the growth of capital in the sector, it gets nasty again, in my view.
I guess one of the things that our forecast is probably that you have peak gold mine supply in, I don't know, maybe 2017 or 2018, depending on your forecast, and then everything's in decline. And if you look at a lot of companies' production profiles, you get the same sort of trend, is that they haven't invested in exploration, they haven't replaced reserves, and they don't have that growth pipeline. Doesn't that sort of support the fact that there needs to be more M&A in the sector?
Yeah, and it's also kind of the genesis for the next bull market in a way, right? I mean, if you think about it, no really significant exploration has gone on in 5 years at least. And the previous 10, you could argue that a lot of that money that was raised was wasted. And so if you sit down with management teams and speak with them at the seniors, they'll tell you that it's probably cheaper to go out and buy at the current time, a well-defined project, and there's not many of those. So you probably will see those things get taken over in the next couple of years, especially if you have strong gold tape. But then there will be a moment, and I don't think that moment's too far away, when there won't be anything left to buy, and there will be a significant inflows into the exploration part of the chain, which I think is quite exciting.
Well, if you look at the junior mining industry, there was actually a lot of M&A happening until about a month or 2 months back. You saw a lot of news releases on that, and that has suddenly disappeared. I think M&A happens and only happens when the industry is in desperation. The desperation is no longer there, and there are not many CEOs who want to lose their jobs. They will rationalize it whatever way they need to, but they want to retain their jobs, they want to retain their salaries. So I think as long as if the market keeps going up, in my view, M&A activities will actually come to a complete halt. But that's just my view.
The one thing, I think you're right about the management teams, but one thing I think which is quite interesting on this point is that previously when you look at the sources of capital, in particular the hedge funds in New York, they were not restricted by liquidity requirements. In other words, you could have a $100 million market cap company, they could put $10 million in, own 10%, and not face any restrictions around their daily liquidity requirements. And I think that that's changed completely. I used to work at one of those hedge funds, and they have very strict requirements about how much they can own of a company and what the time to liquidate a position is. And while you're right about management teams not wanting to give up their job, you're going to see pressure because they're not going to be able to make that step change in market cap because the funds that previously had helped them make that step change either no longer exist or the documents don't allow for them to actually invest in those smaller to micro-cap companies. And so, one of the changes could very well be that companies are forced to actually come together in order to expand until such time when a major can buy them out if they reach that scale.
I think one of the real problems is just the scarcity of good projects. I mean, if you look at a $1,200 gold price, how many really good projects are there? And we speak a lot of big companies and ask, are you looking at something? They say, we're looking like crazy, we're looking everywhere, we don't find value. So at the current gold price, and unless the gold price really recovers, it becomes increasingly difficult to find projects which have good grades, which have good mining parameters, which are also in geopolitically safe countries. Yeah, I mean, there are projects maybe in Ecuador. We know what Lundin Gold is trying to do. There are projects in Colombia perhaps still, but it gets increasingly complex. It gets more dangerous. The risks are getting higher. So what we need for M&A, I believe, is a significantly higher gold price where we then again get projects and now a whole new set of projects which become economic and attractive again. That means also at lower grade. At this gold price currently $1,200, maybe $1,300, that scarcity will remain with us. And I think it gets increasingly difficult for a producer to replace their reserves by M&A, by acquisitions.
There's also like a new model emerging, which I think Sean and the boys at Cisco are working on, which is also this sort of incubator model. They have those, 2 or 3 companies that they sort of brought in-house and are working on. And I wonder if maybe new models will emerge. But fundamentally, I agree with you. There needs to be exploration to make new discoveries, or the price has to go higher to support the development of projects which already exist but need a higher gold price.
I just want to take this, what Joachim was saying, a step further. I think gold industry has too much capital. Now that might sound a bit weird, but the reality is that return from this industry is so low that we actually have too much capital in this industry. And the last thing the industry wants is more capital coming into the sector, because most of this a lot of new capital will actually go into low-grade, bad economics, bad political jurisdiction projects. And that will again be nothing but destruction of capital eventually.
The question is also if the companies can grow by M&A, what are the next steps to improve their market cap or valuation? Have they done enough with the cost cutting and efficiency improvements and so on they have done over the last years either to survive or really come into a valuable company? Is there more room at all? Can they do that? And or are they maxed out already to a point, aside from salary cuts maybe? But that's the big questions. When they can't buy, what can they do internally? Or do they stay in the room and then, because that's the main problem, capital comes in, short-term shareholders want share price improvements, and one wants dividends, the other one wants growth. So and the companies still listened too much in the past to hedging, no way please. So and instead of hedging, you're surviving. That was a big problem as well for some smaller companies.
I mean, you mentioned, well, a couple things, but hedging was one of the things you just talked about, and we've started to see that come back, and it doesn't seem to have the same resistance that it did previously. Do you think there's going to be more hedging of gold going forward?
I hope there won't be, because they're going to lose a lot of money, anybody who will hedge in the next few years. I look at it differently. We're talking a bit micro here, but I look at it from a macro point of view. We're very much into physical gold because we believe the world is in a mess, and we believe you have to have insurance from a wealth preservation point of view, and physical gold outside the banking system is a better insurance than owning stocks that is part of the banking system and part of the counterparty risk. So therefore, we got into gold in 2002 in a big way, and we haven't sold anything, and we still won't sell for many years. And I think we are going to see a bull market. I'm not a gold bull at all. I'm just looking at the risks and the problems in the world, and I see gold as one way of protecting yourself, but also I see from an economic, financial, geopolitical, and also supply-demand point of view that gold is now starting a major bull market. And therefore, I think we have a 5 to 7 year period at least when gold's going to move up substantially. And of course, all the mining stocks will ride on that wave, and they will go up a lot faster than the gold. I mean, 3, 4, 5 times faster, maybe. And therefore, I think that's, if I'm an investor today, I will take that view. You buy something which is unloved and undervalued, especially when nobody wants it, and that's what the sector is now. Even if it's gone, the hue has gone from 100 to 200, that's nothing. I mean, it will go at least to 600 where it was before, probably a lot higher. So you can actually now just invest in good companies with good cash flow or good finance, well-financed companies, and then just go away for a few years and forget about it. That's, I think, what's going to happen in this sector. And sadly, as you said before, there's short-termism and there's this instant gratification. You go in, take a profit, go out. That's not the way to make money. The way to make money is to buy something when nobody wants it, which is undervalued, and that's what the sector is today, and then sit on it for this trend that I see going up for several years.
Okay.
Nobody agrees.
Let me guess, you're long.
Sorry?
I think this comparison between equity prices and gold price has not proved, in my view, the right way to invest. The optionality and leverage has mostly proved to be erroneous in the last 10, 15 years. When gold price went up, gold price did go up 400, 500%. But share prices of most of the mining companies are lower than where it all started. So optionality and leverage actually does not really, it exists on my spreadsheet, but it does not exist in reality, not yet so far. So I would not invest in equities in anticipation of gold price going up in the future. And I think gold price will and should go up in the future. I should invest in gold as a commodity, not in equities, because I'm probably giving wrong signals to the company. I'm taking a skewed risk-reward situation here by overpricing, investing in equity, valuing it as with using a much higher gold price. So I don't think these are two different things. Equities is business, gold is a commodity, and you should look at these two things separately.
Yeah, I would agree. I've shown the graph on the gold price and the different currencies over the last 15 years, and if you just invest in the gold, you still, on total or average, you actually did very, very well compared to the mining stocks.
I wanted to go back to something that we were talking about earlier, and you were talking about one of the barriers to M&A was sort of the entrenchment of management. The other issue that comes up fairly frequently is executive compensation. It's sort of a sort of hot button topic and seems to come up a lot. And we've actually seen a number of management teams take voluntary, reductions in their compensation to reduce the cost. But how do you think of that issue?
Well, Joachim gave a very good presentation yesterday, and indeed the CEO salaries are way out of line, particularly among the miners, compared to what their free cash flow has been, which has been mostly negative anyway. I don't know how in isolation to decide on the salaries they get, but I look at them on an individual basis. If the equity price does well, and if they actually create if they actually create shareholder value, I have no problems in how much they get paid. If they get $10 million, I have no problems with that, as long as it comes out of value they create for the company.
Maybe I can pick up on some points that I mentioned yesterday. Firstly, I'm deeply worried about the detachment of management from shareholders and from their own staff. And it's really this principle of leadership, and I'll repeat myself about many of you have seen my presentation. I honestly believe leadership means you must lead by example. And you need, if you retrench people, if you cut costs and so on, You can't go back, make an announcement about cost cutting, and 2 weeks later accept a bonus of $5 million, especially because lots of the strategic goals on which CEOs get rewarded these days are related to up and downs in the commodity price, in the gold price. So I can lie in a coma for a year as a CEO. If the gold price goes up by $200 and I'm a South African CEO and at the same time the rand falls, the South African rand fell, I don't have to do anything and my share price goes up. This is not the reward. It's not the CEO who can clap himself on the shoulder for that improvement in share price. So what we need here is a calculation and an analysis of CEO improvement independent of the share prices on its own. And the question is, who's doing that? I think you guys on the sell side, you should have a look at it. Now, how much did actually the CEO contribute to the performance of that share, and how much is related to just simply to the rise in the gold price? But critical is the ethical component, and it's, let's be very clear, it's not only the gold industry, it's not only the mining industry. We have it with VW, we have it in the oil industry. We had last week we had a discussion with BP and the mutiny that developed there. So I think there is a deep detachment between ethical behavior of CEOs, not all, let me get clear there, not all, there are lots of good management captains there and company captains, industry captains, but a big part of the CEOs that we see don't have the ethical fabric to really show true leadership. And that's a big concern, and I'm also concerned that this will change. I don't see it in the moment.
So going forward, you just don't see any mechanism or willingness to really improve that?
Look, who's looking after the CEO, after the salaries and bonus of the CEO? It's the board of directors officially, but it's so intransparent. Are board of directors really independent? There's a lot of networking between companies and so on. So I hope it improves to the better. I hope us shareholders, us investors are who have a say with bonus. And we saw mutinies with VW. We saw it in the oil industry. So I hope that we really improve on that. But I'm a bit worried that it's not happening.
But isn't the problem in the world that you have, first of all, you have the back scratching between all boards and all CEOs, etc. Everybody helps each other. Number one. Number two, you have greed, and the whole system is like that. Sadly, I don't think you're going to cure that disease easily. But I agree with what you say. But I said it's sadly it's something that is part of an era of too much of everything and too much and greed and decadence, in my view. So I don't think it's going to happen, but I wish it would. But that's not just for the mining industry, that's across the board, of course.
Notwithstanding those points, I mean, the reality is probably most everyone in this room, at least once this year, has voted a proxy, and you voted for the board who ultimately paid the CEO. And so obviously you would hope there would be restraint on an individual and, the board would control him. But ultimately, as shareholders, we can vote with our own voice as well. So we need to make sure that everyone will have a different view here about what they think is right, but that you're expressing your views through your proxy.
But Anthony, the voting does not really work that way. It's very difficult to influence management using the voting procedure. Actually, you either vote for the management or withhold it. I can't vote against them in the first place anyway. So I think the voting procedure and the regulatory framework
It depends on the jurisdiction, right? Like I think in Australia, if you vote down the compensation report 2 years in a row, the board is swept out. So there are mechanisms, and granted, it's quite challenging. But I'm just saying that, if shareholders were truly irate, upset, I think you could see action taken in specific companies. So it's a lot of work. Admittedly, it's not easy, but it could happen.
And they had a lot of chances in the last 5 years to come forward, the CEOs, and lead by example and say, okay, my share price went down from 10 to 2 or 3, and actually it would be interesting to have a ratio, how many actually did come forward. I don't think there's many of them. And of course, it's the same thing if you look at Volkswagen, right? I mean, they didn't do the same thing across the board as everywhere, but they could have done it and they didn't. So maybe if they have to get forced it somehow and find something like if they tie to the share price on the upside, maybe there must be cuts on the share price on the downside.
Can I just exemplify that because it reminds me, it reminds me of 2007. The world almost went under. I have a few sons-in-law. One is the managing director of Morgan Stanley in London. And so I preach to him every year that things are going to get more difficult. 2007, I said, Morgan Stanley almost went under. The Fed and the Japanese bank had to save Morgan Stanley. And, these guys in the city, like my son-in-law, gets ridiculous 7-figure bonuses because that's part of the system. The system agreed. So that year when Morgan Stanley almost went under, he got the same bonus as the previous year. So that's what's happening in the system, and it's very difficult to fight that trend as long as the company survives, therefore, I think it would be a tough battle.
Okay, we have some microphones at the back of the room, so if anybody has a question that they'd like to ask to the panel, just raise your hand.
My question is, the shareholders have nothing to say because the shares are voted by, how do you call it, not the funds, the pension funds, and they vote the blocks. The individual goes to a shareholder meeting can stay home. It's not important. But I don't understand that the BlackRocks of this world, who are big shareholders in a lot of these companies, and I was a shareholder in one of the companies where they were one of the major shareholders, they let management do whatever they want. They let them fly first class, live in suites, and do what the heck they want. They don't do anything about the costs, and I don't understand why.
No, I don't think you're BlackRock.
Evie's not up here.
Couldn't ask us.
Some of those mutual funds are required to vote along, what are they called? They're not proxies, but the recommendation. They're required to vote in line with the recommendation, but everyone will be different.
Well, I completely agree with you, actually. I just don't have a response to you.
Yeah.
But I mean, to be fair to one of the portfolio managers at BlackRock, he's been quite active in his condemnation of some of the things that we're talking about right now. So I don't know how he's voted, but surely he's gone on the record in a number of different forums, bemoaning some of the shenanigans that have occurred over the past kind of 5 or 10 years.
I guess, so moving on from executive compensation and those types of issues and back to exploration, which I think is, a more interesting sort of topic in a lot of ways. If you look at significant discoveries over the last 10 or 15 years, there's, charts that show just the number of discoveries has been declining. So, I think companies tend to get a premium that, have exploration potential. I think they get valued at higher multiples, but it seems like the cycle for exploration isn't matching the cycle for mines in terms of the development cycle from discovery to production versus, the need to replace that production. And is that just a matter of decreasing maybe your standards and accepting lower grade type deposits or things like that, or is there something that needs to change? And you talked a little bit about the commercialization of exploration, for lack of a better word, that Cisco is doing, but is there something?
Well, I think what Cisco is doing is quite interesting, but from my perspective, if this is the recovery that everyone hopes it is, it would make sense that you would first see the seniors re-rate, and then it would move down market cap until such time as these stocks are fully valued, and then it would move into exploration. So for me, it's a natural progression that it would start with the largest cap companies and then slowly work their way down through. So I would see it as natural. I mean, I don't know what gold's going to do, but it would make sense to me that would lag. And in fact, when I look at gold names, I think right now, assuming a flat gold price, because I'm unable to predict the future. I mean, I wish I had a view on gold, but I don't. But if it's flat, I think the most interesting area right now are some of the smaller cap companies that haven't run as hard as the larger ones, or that still have room to run even though they have gone up multiple times. So I think this is an interesting area.
Yeah, I think some of the junior mining companies offer very good value just because a lot of people have not looked at those companies. But again, a lot of those junior mining companies should not even exist. So 80 to 90, or I don't know what percent that is, but a lot of junior mining companies have no value and will have no value. But I fully agree there are some junior mining companies that offer good value, and that's where you might find the best value as an investor.
As you say, they're trades. I think one of the analysts at one of the banks I read recently, he wrote something, we don't own these stocks, we rent them. And I sort of wonder, there are probably these names where they have a $30 million market cap today and they're going to have a $100 million market cap in 2 weeks, and maybe it's just a round trip, but you have to get out.
I guess we've been talking a lot about gold. Just on the silver side, the gold-silver ratios come back a little bit. And maybe, Björn, I don't know if you have an opinion on whether it potentially reverts back to historical levels or how we see the silver price performing.
Well, Björn talked about that, and I talked about it this morning, and I show the graph also. I think, and we actually, also from a cycle point of view, forecast the February peak in the ratio at 83 something, 50, whatever. I think that was the peak, and it was also, if you look back, an historic peak. It's been there a few times. I think it's turned, and you see, the speed at which it's moved down, and we've gone from 83 in February, and also into March, about first couple of weeks in March, we were almost 83, and now we're 73 today. When that ratio moves, it moves so fast, and I think we will, the first target to me is the 30 level in 2011. And whether, maybe, obviously silver is so volatile, we will have wild fluctuations. But, whether we get to the historical average of 15 or not, I don't know. But that's a possibility also. What is clear to me is that silver will vastly outperform gold in the next few years. But it's not for widows and orphans. The ride you get with silver is such a wide ride that you're not going to sleep well at night, and certainly your investors will not sleep well if you have a big exposure. But certainly to have some exposure to silver is going to give you a lot of potential.
But the industrial component to silver, and it's linked to Chinese data, I think is very different than gold. And notwithstanding the ratios, which I don't claim to know anything about, I worry that you're going to see, or potentially see significant volatility, as you're saying, just based on Chinese industrial data. Whereas with the precious, in particular gold, maybe it continues to go up, notwithstanding whatever's going on in China.
No, I agree with you. You should have more gold than silver, definitely. Our investors average might have 85-15, 85 gold, 15 silver because of the volatility. But I think gold will become poor man's silver. Silver will become poor man's gold. You don't have to worry about, because it's such a small market, you don't have to worry about the industrial side. It will be an investment commodity rather than an industrial commodity, and people will buy it for investment purposes. That's how I see it, because gold is too expensive.
Any thoughts on silver?
Andrew, I don't really see any rational reason behind this ratio. You can create a ratio between gold and oil and gold and corn, anything. You can create ratios between, and you can see correlation between them. You can see the two things getting normalized with time, but that does not tell you about the future. And I see nothing that helps me create a ratio between gold and silver. So they can diverge and they can come back, but that has nothing, I don't see any connection really.
Also I agree on the industrial side. I don't know the actual stockpiles number, but once they start going down a bit, then at some point the demand kicks in, they bring it back up, and they have an extra kick on the silver price usually. And on the silver stocks really had a massive run already. You see it in the fund, and it's a question. It's such a limited space, and last few years, what new silver projects really came on stream? Not. And so that is a limited thing as well, and most silver companies bought a lot of gold exposure.
Just shifting gears a little bit, the royalty space is a space that's received a lot of attention, and it seems like there's more and more royalty companies being formed to try and participate in that space. As investors that can invest in the royalty companies or the miners, I mean, how do you view those companies?
I think it's a source of capital. It's an important source of capital for the industry. Personally, I mean, I think when I see some of the royalty companies that I respect, when I see that they've invested in a company, to me that means, obviously that there are instances where they don't get it right, but to me it means like, you know, they've looked at this is potentially a quality company, so I see that as a signaling mechanism. People like to criticize the royalties, but the reality is the sources of capital that financed a lot of these mines just haven't been there over the last 5 or 6 years. And so it's easy to, you know, to criticize the deals that the management teams have done, and I think that's not right, because it was either that or do nothing. And so I actually think that they've contributed positively to the industry, and I'm quite happy that they've been there. I also think as a product, it's very interesting. If you're a generalist investor and you don't want to deal with thinking about, you know, one management team and his 6 mines or whatever it is, it's a great way to come into the sector and buy a basket of exposure. So I'm quite optimistic and constructive on these names, even though they get criticized unfairly, I think.
Yeah, I also think they're an additional instrument. I think they sit somewhere between ETF and an operating mine. So you have some of the operational risk you don't have to that extent than when you invest in a producer, but you have still some, and you have definitely more risk than when you invest in an ETF. So it's somewhere in between there. It doesn't have the leverage. If you really believe in gold or in silver, you probably want to be in a highly leveraged company. If you want to take a little bit less risk on, you go into the royalty companies. If you want the least risk, you go into the ETF. So I think it's an additional instrument with its benefits.
And also they tend to get more money. It's self-fulfilling. I mean, they trade on the premium, the investor likes it, so more money comes in, more money they have to spend, so more projects get financed through them.
Okay, again, if there's any questions, just raise your hand and look for a microphone. But I guess let's try and sort of wrap up, and maybe looking forward as you're meeting with companies here, and maybe everybody can sort of have a bit of input here. As you're meeting with companies, you know, looking at the space right now, what advice or what are you talking to them about in order to sort of generate returns in the next year? What are the key sort of themes that you see facing the companies going forward?
Well, for me, important are the catalysts. What are you doing over the next 2 or 3 or 4 quarters that enhance value, that de-risk the projects that you're looking at, and what can bring me more value? Do you have political risk? How do you cope with that? What do you do about your cost structures? What do you do about your exploration outlook? So I like to look at producers. I like looking at large cap companies. There's value in some there, but I also like to look at the junior explorers there. So each of these spaces has its own benefits, advantages and disadvantages, and I think we're moving into a period where we need to diversify in order also to diversify our risks that we take. So if you have to stay in gold, if you can't go into other mining sectors, then within the gold and precious metal sectors, you should diversify between the different market caps, I think. So we like to look at every space individually, and there are good large cap companies and there are good explorers out there.
Well, if I have to give suggestion to the management, I'm mostly interested in starting to return back my money through dividends. And I think paying back 1/3 of the profit or 1/3 of the cash flow back as dividend is something that the sector eventually has to think about. They can't just keep investing money in more and more projects. It also gives a very good discipline to the management, because then management is forced to, when they start returning money, it disciplines everyone. I think that's what I would suggest to them. Okay, and then I guess going through, what do you think are the key
themes that you think will drive equity performance over the next year? I mean, gold price aside.
I think the key, I think you're going to see a catch up in the smaller cap names, and potentially, later this year or next year, if there's a strong gold tape, I think you will see majors make acquisitions for the remaining kind of quality projects out there.
Definitely focus on operational excellence, cost cutting, etc. Don't let it get out of the roof as it was. Learn from the past if you can. Maybe put your salaries at a plan just to address that again. But definitely, and for the smaller ones, it depends how much capital will be available, and then definitely we will see more M&A.
I think exploration excellence on the one side, and I believe there's a scarcity, increasing scarcity in that sector, and solid operational performance on the other side, if you look at these two ends of the spectrum.
Yeah, I completely agree with that. I think the quality of management will decide going forward which companies will eventually do well for the shareholders.
Is there any jurisdictional sort of layer that you put on that, or are you fairly agnostic in terms of where assets are located?
I think one thing we didn't discuss at all today is currency and how that has really impacted. I mean, it was touched on with South Africa, but you have that with Australia and Canada, and clearly the profitability of these mines based on currency is in some cases what saved them or made them highly profitable. And so jurisdiction, I think, notwithstanding political risk, is going to be really related to the currency where their cost base is.
I think political risk is a huge factor. In the last decade, people invested a lot of money in countries like Mongolia or Central Asian republics, Africa, crazy places in Africa. They lost a lot of their money. And the problem with bad jurisdictions is that if the commodity prices do well, the government will take away your project anyway. And if the market is bad, you lose your money anyway. So with bad jurisdictions, I see no reason why you should invest in some of the bad jurisdictions.
Okay, if there's no further questions from the audience, I think we're going to wrap it up. Thanks everyone for participating. I think we've heard a lot of certainly positive thoughts on the sector going forward, and look forward to reconvening next year and seeing how things go. Thank you.
Thank you.